Investing involves putting your money in some financial product to generate returns. In India, you can invest in stocks, bonds, real estate, gold, PPF, NPS, FDs, and many options. But over 19 crore Indians are investing in mutual funds. That's more than the population of Japan. So clearly, it is a popular investment option. But what exactly are mutual funds? What are the different types? Why are so many people investing in them? And finally, how can you get started? These are the questions we will answer in this video. Let's say you invest in a stock. You buy 5 shares for 100 rupees at 20 rupees per share. After a year, the share price grows to rupees 40. So your investment value increases to rupees 200 and you have made a rupees 100 profit. But the issue is that your stock may not always grow in value. It could lose value and you could go into a loss. So you do some research and decide to take that same 100 rupees and divide it into 10 stocks of different companies. Some share prices may go down, some may go up. This is called diversification. The thing is, if you diversify your stocks properly, you have a better chance of earning good returns. This is how a mutual fund works. A mutual fund takes your money and invests it in various stocks, bonds, and other securities to diversify your investments. But here, you aren't the only one investing. The mutual fund pools many people's investments and then invests it. You end up owning a part of the whole mutual fund based on your investment amount. As of today, Indians have invested 61.16 lakh crore in mutual funds. But where are these mutual funds and who manages them? You may have heard of SBI Mutual Fund, Nippon Mutual Fund, and Aditya Birla Sun Life. These are called asset management companies or AMCs. There are 44 AMCs in India, and each AMC creates various types of mutual fund schemes with different investment strategies. But the question is, within the mutual fund scheme, who is managing all these investments? One mutual fund scheme could be managing the investments of lakhs of people. So who is deciding how much to invest and where? There's a professional called a fund manager who takes care of that. They decide where to invest the money to get the best returns. Let's quickly look at what this fund manager does exactly. Let's take the example of Ronak Onkar, one of the fund managers of Parag Parikh FlexiCap Fund. It's important to know here that Parag Parikh is the AMC name and Parag Parikh FlexiCap is the mutual fund scheme name of this AMC that follows a FlexiCap investment strategy. So let's look at the list of responsibilities that Ronak has. Number one, he makes sure the fund follows the FlexiCap investing strategy, which means he invests in small or big companies and adjusts the allocation based on the market condition. Number two, he looks for undervalued companies with a good business model to invest in. Number three, he manages the portfolio's risk, ensuring it's in line with the fund's objectives. Number four, he ensures that the fund is generating better returns than the Nifty benchmark and possibly the peers. Number five, he makes sure the fund complies with SEBI guidelines. So now we know what a mutual fund is and what a fund manager does. Now the question is, how does a mutual fund earn returns? Before I explain this, we need to understand what net asset value is, or NAV. NAV is nothing but the unit price for the fund. You will be allocated the number of units based on this price. To understand it simply, if a fund's NAV is rupees 50 and you invest 10,000 rupees, then you get 200 units of that fund. Now this fund is investing in a lot of stocks and bonds. When the share price of those stocks increase or the bonds have matured and generated some returns, then the net asset value also increases. So let's say in a few months the NAV is now rupees 70. Then the value of your 200 units will now be 14,000 rupees and you will have made a 4,000 rupees profit. So now you understand how a mutual fund earns returns. But the question is, why should you invest in mutual funds in the first place? You might think you could just save it instead or use that money to buy a car. So let's cover the top 3 reasons why you should invest in mutual funds. First up, we have inflation. Prices of everything is increasing and your money sitting in your savings account is losing the power to buy things. Right now, inflation rate is around 7%. which means generally every year, everything is becoming 7% more expensive. It might not seem much now, but in 10 years, the 1 lakh savings you have will only be worth 50,000 rupees based on these rates. Number 2, compounding. Let's say a mutual fund is expected to have a 10% CAGR. So the 1 lakh you invested today earns a 10% return and becomes 1.10 lakhs the next year. In the second year, your 10% growth will now be on top of that 1.10 lakhs as long as you don't take out any of the money, and then you will have 1.21 lakhs. So during your first year, your profit was 10,000 and in the next year it was 11,000. Let's say you leave that 1 lakh alone for 10 years. That investment would be worth 2.5 lakhs. If you left that 1 lakh in a savings account, on the other hand, it would only be worth 50,000 rupees due to inflation. So you have not only beat inflation, but you have earned more returns because you stayed invested for a longer time. Another great example to understand compounding is that if you invested 10,000 rupees every month and it's growing at a rate of 12% per annum, then in 20 years, you should have nearly 1 crore. But just 6 years after that, you will have nearly 2 crores. And after 4 years, you'll have 3 crores. In 2 years, you'll have 4 crores. And then in 1 year, you will have 5 crores and so on. That is the power of compounding. Number 3 is economic growth. Based on the projections and various reports, India is on track to become a $40 trillion economy in the coming decade. And investing in mutual funds is a good way to capitalize on this growth. In the last decade, markets gave around 10% annual returns. But with a proper strategy, you could earn better returns in the following years because of the predicted economic growth. Number 4 is retirement and increasing lifespan. As modern medicine improves, everyone's lifespan is increasing. This means you need to have enough wealth to last longer than your lifespan to avoid being in a situation after your retirement where you have to enter the workforce again. So these are the reasons why you should start investing as early as possible. Before we go any further, let's take a closer look at what is inside a mutual fund now. A mutual fund has investment assets. An asset is anything that holds some kind of financial value. A mutual fund can be holding various assets. So let's go through all these asset classes one by one. Number 1, we have equity. These are your company stocks like Reliance, Tata, SBI. The important thing to note about equity is that it is heavily affected by market fluctuation. Number 2 is debt. This can be corporate or government bonds, debentures, anything that has a fixed return rate, unlike equity. The important thing to note here is that debt is a more stable asset class than equity. Number 3 is commodities. This can be gold or silver investments. Usually, commodities are used as a hedge against inflation in your portfolio. Number 4 is cash. Mutual funds usually keep 1 to 5% of their total assets as cash to ensure there is liquidity in the fund. Now that you understand what assets are inside a mutual fund, we can move on to the different types of mutual funds. But before we cover the various types, you need to know every mutual fund scheme has 2 plans, regular plan and direct plan. The main difference is that when you're investing through some brokerage app or mutual fund distributor, you end up investing in the regular mutual fund plan. Regular mutual funds include a commission that is paid to the broker or distributor who might be providing you more features like rebalancing or investment recommendations. Direct mutual funds, on the other hand, don't have this commission. If you want to invest in a direct mutual fund, you have to go to the AMC's website and directly invest there. Now, there are more than 5,000 mutual fund schemes out there and they vary based on their investment goal. We are going to cover some of the main types of mutual funds one by one. Number 1, we have equity funds. These funds invest at least 65% of their assets in stocks. They're a little bit risky because they're obviously affected by the stock market fluctuation, but they have the potential to give you high returns. For example, equity funds in India have given an average return of around 12 to 15% over the past decade. Number 2, we have debt funds. Debt funds invest in bonds, debentures, and fixed deposits. These are assets that have a fixed return. Now, debt funds are usually less risky and they tend to provide steady returns between 7 to 10% per annum. Number 3, we have hybrid funds. Now, these funds invest in a mix of stocks and bonds. The allocation can vary depending on the specific scheme. For example, aggressive hybrid will have more equity, conservative hybrid will have more debt, and balanced hybrid tends to have an equal amount of equity and debt. Number 4, we have index funds. Now, index funds track a specific market index. For example, the Nifty 50. Here, the fund manager doesn't have to do much. All he has to do is make sure that the fund is investing in the top 50 companies like the Nifty index, and the returns reflect the index's performance. So if the Nifty 50 goes up, so does your investment. Number 5, we have sector funds. Now, sector funds invest in companies that belong to a specific sector. For example, a healthcare mutual fund will invest in companies like Apollo or Cipla. A technology mutual fund will invest majorly in companies like Infosys, TCS, Wipro. One thing to note is that sector funds are normally quite risky, so you should do your research well before investing. Number 6, we have ELSS funds. Now, if you're using the old tax regime, then investing in ELSS funds will allow you to deduct taxable income up to 1.5 lakhs under Section 80C. The benefit is that ELSS funds invest in equities and earn good returns, but the catch is that your money is locked in for 3 years. Now, before we move on to understanding how to choose a mutual fund and how you can start investing in them, let's quickly understand how mutual funds have some benefits that other traditional investment assets don't have. Number 1, we have stocks. Mutual funds are less riskier than stock investing because an equity mutual fund diversifies your investment across various stocks. Now, you could, of course, do this yourself, but you have to spend a lot of time researching and monitoring your investments, which a mutual fund manager could instead do for you. Number 2, fixed deposits. FDs have been the go-to option for Indian investors for many decades because they have low risk. But debt mutual funds are a great option for low risk and at the same time better returns. Mutual funds also give you the ability to do tax harvesting, which FDs don't have. That's why you end up paying more taxes with FD investments. We won't be covering tax harvesting right now. Number 3, we have PPF, NPS and other government schemes. Now, there are a lot of government-backed savings schemes which give you a moderate return between 7 to 10% per annum. But the disadvantage is that you have to lock in your money for a very long time, sometimes even till you're 60 years old, like an NPS. Now, mutual funds don't have a lock-in period except for ELSS. And at the same time, they give you better returns than most of these saving schemes. Number 4, we have gold. Now, physical gold investments require additional expenses towards security and maintenance. There's also the risk of impurity. Instead, you can go for gold mutual funds, which doesn't have any of these expenses and risks. Number 5, we have real estate. Generally, long-term mutual fund investments give at least 12% return per annum, whereas real estate investment gives you around 8% returns, excluding rental income. Also, recently, indexation benefit has been removed on long-term capital gains tax, and this can significantly affect your returns in real estate investing. One last thing you need to know about mutual fund investing before you get started is the taxation. An important thing to know is that you are only paying taxes when you sell your investments, not when you're holding them. Now, there are two kinds of taxes on your investments. There's short-term capital gains tax and long-term capital gains tax. Short-term capital gain tax or STCG tax applies when you sell your holdings within 1 year from the investment. Long-term capital gains tax or LTCG tax applies to profits from assets held for more than 1 year. Now, the taxation is different for every type of mutual fund. Starting with equity funds, short-term capital gains tax is 20% and long-term capital gains tax is 12.5%. The LTCG exemption limit is rupees 1.25 lakhs. So you will only be taxed on the profits that are more than that amount. Next up, we have debt funds. Now, capital gains from debt funds are taxed according to the investor's income tax slab rate, regardless of the holding period. Finally, we have hybrid funds. Now, the taxation of hybrid funds depends on the fund's asset allocation. If the asset allocation of equity is greater than or equal to 65%, it is treated as an equity fund. If the asset allocation is less than 65% of equity, then it is treated as a debt fund. So now you know what are mutual funds, you know all their types, you know what are the benefits over other investment options. Now let's understand how to choose the right mutual fund. Number 1, set your goals. Ask yourself, what are you investing for? Is it for retirement or a new car or maybe a vacation? Your goal will help you determine the investment horizon. If it's for retirement, then your investment horizon could be longer. So that means you can take on more risk. If it's for a huge purchase like a car in the next few years, then you might prefer a conservative hybrid fund, which is less volatile. Number two, understand your risk tolerance. Most of the time, your age is linked to your risk tolerance when you're investing in the long term. The rule of thumb is to take 100 and subtract your age, and that is your recommended equity allocation. So if you're 30, you can have a portfolio that invests 70% in equity and 30% in debt. This is useful when you're planning for retirement. Number three, check the past performance. Look at how the fund has performed historically. While past performance doesn't guarantee future returns, it gives you an idea of how the fund has done in the past. Every fund has a benchmark. For example, the benchmark for equity funds is usually Nifty. If your fund has not been able to beat the benchmark in the last 3, 5, or 10 years, it's fair to say it might not be a good investment. Number four, look at the expense ratio. The expense ratio is the fee the fund charges for managing your investment. A lower expense ratio is always better. For example, if a fund's return is 10% per annum and the expense ratio is 1%, your actual return is 9% per annum. Also check the exit load. The AMC charges you a fee if you redeem your investment before a certain time. Number five, consider the fund's size. Funds with a larger AUM or assets under management often provide stability, but might offer lower returns compared to smaller funds. Now that you have chosen your mutual fund, you have two options to start investing: SIP or lump sum. SIP or systematic investment plan is a disciplined approach to investing in mutual funds. Here, you regularly invest a fixed amount every week or month. Most SIPs are on a monthly basis. This can be automated with your bank, so you can start an SIP and keep it going until you reach your goal. A lump sum investment is when someone invests a large amount of money in one single transaction instead of breaking it up into smaller payments over time, like an SIP. Now, investors often debate between SIP and lump sum investments, asking which is better, which will give them more returns. One of the main differences between the two is that SIP gives you the advantage of rupee cost averaging. Let us quickly understand what rupee cost averaging is. Now, the markets move up and down very often. During an SIP, you're investing the same amount all the time. So when the markets are up, your NAV is higher. So you end up buying fewer mutual fund units. When the market is down, your NAV is lower. So you end up buying more mutual fund units. This averages out the price at which you're buying the units and helps you deal with the market volatility. With a lump sum investment, you don't have this advantage. Now, lump sum investments or one-time investments are typically preferred by experienced investors who have a high risk tolerance. It requires you to time the market, which is a very risky game. But if you're planning on making a one-time investment for the long term, then a lump sum could work. Here's three things to consider before you choose between lump sum or SIP. First thing is the investment amount. If you have a substantial investment amount, you can opt for SIP to make smaller regular investments. Number two is the market timing. Lump sum works well when the market is low, while SIP distributes your investment over time to avoid the risk. Ultimately, your choice between SIP or lump sum should align with your income, your goals, and your risk appetite. Stack Wealth is a new age investment management company that helps you take your wealth to new heights. Our team consists of experts with 25 plus years of experience managing investments for more than 1 lakh investors. Our team of experts help you curate a personalized mutual fund portfolio based on your goals and risk tolerance. They help you decide your asset allocation. They also help you identify high performing sectors to help you generate additional returns. And finally, we help you manage and monitor your investments in real time. First, download the StackWealth app from the Play Store or App Store and complete your sign up by entering your mobile number and email ID. Now you can explore the app, get your personalized mutual fund portfolio, or browse our various investment opportunities. To start investing, you have to complete your KYC. Once your KYC is completed, you can start investing in your personalized mutual fund portfolio or explore our expert curated investment opportunities. If you're not sure where to begin, your dedicated wealth manager will help you. Now you can start an SIP or make a one-time investment. Remember, you can always pause your SIP anytime and edit the SIP amount if you want to increase or decrease it. Finally, you can sit back, relax, because our wealth team will rebalance your portfolio based on shifting market conditions, identify and recommend new investment opportunities, give you monthly portfolio reports so you know exactly how your portfolio is performing. If you found this video helpful, don't forget to hit that like button, subscribe to our channel, and tap the bell icon to stay notified, because we are making finance and investing as simple as possible for everyone. Thank you for watching, and goodbye.